Hello and welcome back to the channel, Savvy Investors. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and potential short squeezes. Our spotlight stock for this educational breakdown is a very specific name that's been lighting up our screeners, Zhongqiao Inc., ticker symbol ZCMD. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show ZCMD chart and logo. Zhongqiao Inc., trading as ZCMD, is a healthcare information services company based in China with a current market cap of about $6.07 million. They provide healthcare information, education, and training services to medical professionals primarily under their MD brand. They also operate a segment focused on the sales of patented drugs. ZCMD has an estimated float of just 1.1 million shares, making it a microcap with a relatively tight supply of shares in the open market. Our internal composite squeeze score currently places ZCMD at 47.5 out of 100, indicating some underlying factors worth exploring. Looking at recent price action for ZCMD, today it's up a modest plus 0.93%. Over the last 5 days, it's seen a plus 2.83% increase, but the last 30 days show a drop of minus 8.40%. Volume-wise, today's trading volume is around 1.2 million shares, which is significantly lower than its 30-day average volume of over 10.5 million shares. That means its relative volume is currently just 0.1x its average, suggesting very low current interest. What is cost to borrow and why it matters? So, what exactly does hard to borrow mean, and why should you care? When a stock is hard to borrow, it refers to shares being scarce or difficult for short sellers to find and borrow. To short a stock, you first need to borrow shares from someone who owns them. The cost to borrow CTB is the annualized interest rate short sellers pay to hold those borrowed shares. Think of it like paying rent on the shares you're betting against. When this fee skyrockets, it's a huge flashing red light for potential short squeeze conditions because it signals intense demand to short a limited supply of shares. Why the stock is hard to borrow right now. Now, let's talk about ZCMD specifically. This stock appeared on our hard to borrow screener because its cost to borrow fee is an astonishing 846.6% annualized. Highlight CTB number to put that into perspective. Most stocks have CTB fees under 1% or 2%. An 846.6% fee means short sellers are paying an incredible premium just to maintain their short position against Zhongqiao Inc. We currently don't have visibility on the exact number of shares available to borrow, but with such a high fee, it's safe to assume availability is extremely limited. This scarcity, combined with ZCMD's small 1.1 million share float, creates a very challenging environment for anyone trying to bet against the company. Squeeze mechanics explained. So, how can this situation lead to a short squeeze? It's a chain reaction. When a stock like ZCMD has a very high cost to borrow and a limited float, any significant upward price movement can put immense pressure on short sellers. They are not only losing money as the stock price rises, but they're also hemorrhaging cash daily due to that 846.6% borrow fee. This pain can force them to buy back shares to close their short positions, which creates buying pressure. This buying pressure, in turn, can drive the price even higher, trapping more short sellers and forcing even more buybacks. This feedback loop is the essence of a short squeeze, a rapid, volatile price increase fueled by short covering. However, it's crucial to remember that a high cost to borrow doesn't guarantee a squeeze. It can also signify that short sellers have extremely strong conviction in their bearish thesis and are willing to pay almost any price to stay short. Dilution risk check. When we look at short squeeze potential, dilution risk is a critical factor. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can flood the market with supply. More shares mean more opportunities for short sellers to cover their positions, or for institutions to buy, potentially absorbing any buying pressure from a squeeze. This can completely negate a short squeeze thesis, even with high borrow fees. For ZCMD, we've found no recent diluted SEC filings such as -1s, -3s, or 424 BS in the last 90 days. This is a positive sign, as it means new share issuance isn't currently a concern that could undermine a squeeze scenario. Recent reverse split watch. Another important factor for ZCMD is its recent reverse stock split. Zhongqiao Inc. executed a 1-for-3 reverse stock split on June 29, which was 42 days ago. A reverse split reduces the total number of outstanding shares and proportionally increases the share price. For example, if you had 3 shares at $1 each, after a 1-for-3 split, you'd have 1 share at $3. Crucially, a reverse split also reduces the float. Historically, we've observed the pattern where many microcap stocks tend to see renewed volatility or price pop within about a month after a reverse split. The reset price and lower share count can sometimes attract new interest or short-term trading momentum. While ZCMD is slightly past the typical 1-month window, it's still relatively recent and falls within a period where some microcaps have shown increased activity post-split. This is a pattern, not a guarantee, but it's an important aspect of ZCMD's current situation to be aware of. Let's take a quick moment for our disclaimer. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for with John Chow Inc., ZCMD? The key elements are its extremely high cost to borrow fee of 846.6%, the tight estimated float of 1.1 million shares, the absence of recent dilution risk, and the relatively recent reverse split which reduced the float and reset the share price. Given its current relative volume is just 0.16 average, a significant increase in trading volume for ZCMD would be a crucial indicator. Sustained buying pressure on higher than average volume could signal increased interest and potentially start to put pressure on those short sellers currently paying those exorbitant fees. Keep an eye on any sudden surges in trading activity. John Chow Inc. ZCMD presents a compelling educational case study for understanding the mechanics of hard-to-borrow stocks and potential short squeezes. With its sky-high cost to borrow, tiny float, and recent reverse split, it's certainly a name that stands out on our screeners for these specific conditions. Remember, this is all about education, not recommendation. Always conduct your own thorough due diligence. If you found this breakdown of ZCMD and short squeeze mechanics helpful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what other hard-to-borrow stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.